So what should you do? What's the best things you can do for your when you're investing for your retirement? Make sure you've got some diversification. There is another article which I read this morning about a guy called Bill Bingen. Now, he's a US financial planner who did a lot of studies on, how can you maximize your returns without generating too much risk when you have to make a drawdown in all sorts of market circumstances. And I'll try and summarize some of that detail that he's produced. He basically says you can typically draw down up to about 4.8% per annum without having too much risk on your retirement, not lasting as long as it should. He does say you should, diversify into fixed interest and property assets from equities, and also diversify within equities. You should have some small cap exposure. You should have some international exposure. You should be probably in some private equity exposures. And the more you can diversify, the more you can generate a higher return without increasing your risk too much. You do need to have risk assets in there just so you can beat inflation. What the InvestSMART mantra has always been: make sure you watch your fees and costs. You can't control the outcomes from your investments. It is what it is. The markets will move, but you can control how much you spend, and what it costs you, and what fees you have to pay to get those outcomes. And we do stress that you should try and minimize those fees and costs wherever you can, because that will make a difference. If you've got a 7% return in your super fund and you're paying 1 to 1.5% in fees, that's a fair difference than if you're only paying, say, 0.5% in fees, in terms of how much you can spend and how much it will grow. On a other note, just things you should think about before you retire, before you stop working. As I found out, it's very difficult to borrow money when you've retired. Once your regular income stops, most lenders, banks, will not look at your retirement income as a source of income that you can repay debt with. They'll look at that, well, that's just to pay for your lifestyle. So if you can set up debt facilities, I set up one on my house just as what I look at it as is a sort of emergency fund. If I decide, going back to this sequencing risk, if I decide I don't really want to draw money out of my super fund because markets have fallen, I can borrow money against my house and use that to spend and wait for markets to actually recover. So, it gives me the flexibility to adjust where I get my income source from.
I've done the same thing, Alastair.
Yeah, and it's interesting. Credit cards are the same, Alan. Once you're over the age of 65, it's very difficult to get a credit card. So keep the ones you've got. And then my last point, Alan, just enjoy your retirement. We are in this country. I think we're blessed with a system where our standard of living is very good. We've got plenty of time, and just do the things you want to do when you retire, and don't worry about money too much.
What a good idea. That's excellent. Excellent advice. Excellent advice. So are there any, so is that it?